Son. At its peak, Sears was not just a store, it was the infrastructure of American life. More than 300,000 employees, nearly 900 locations across the United States, a catalog business that had once delivered everything from wrenches to prefabricated houses directly to American doorsteps. Revenue that, in its strongest years, surpassed $60 billion annually. Then, in October 2018, Sears Holdings filed for Chapter 11 bankruptcy protection. The company that had defined retail for over a century entered a process that would close hundreds of stores, eliminate tens of thousands of jobs, and eventually leave behind a brand operating a fraction of its former scale. The question is not simply what went wrong at the end. The question is, why a company with that much scale, that much brand equity, and that much history could not find a way through? The answer begins more than a century before the bankruptcy filing. Richard Sears founded the company in 1886, initially selling watches by mail. Alva Roebuck joined shortly after. What they built was not a store in the traditional sense. It was a distribution system designed to reach customers that traditional retail could not serve. Rural American families in the late 19th and early 20th centuries had limited access to goods. Local merchants charged high prices with little competition. The Sears catalog changed that equation entirely. Thousands of products, illustrated and priced, delivered by railway and rural free delivery. It was a logistics and pricing disruption that preceded the modern e-commerce model by roughly 100 years. By the mid-20th century, Sears had evolved from catalog giant to physical retail anchor. It followed the American population into the suburbs. It became the anchor tenant that shopping malls were built around. Sears did not just sell appliances, tools, clothing, and automotive products. It created private label brands that consumers trusted and returned to. Kenmore for appliances, Craftsman for tools, Die Hard for batteries. These were not just product lines, they were household names with genuine consumer loyalty and measurable price premiums. For decades, that combination of physical presence, private label strength, and catalog reach made Sears nearly impossible to dislodge. The peak came in the 1970s. Sears was not only the largest retailer in the United States, it was the largest retailer in the world. The Sears Tower, completed in Chicago in 1973, was for a time the tallest building on Earth. That is not a coincidence. It was an expression of institutional confidence, a company that had no visible reason to doubt its own permanence. But the structure that had made Sears dominant was already beginning to lose its relevance. The first crack was competitive, and it arrived quietly. Discount retailers, particularly Walmart and Kmart, were building a different model. Lower overhead, aggressive supplier pricing, and a focus on volume rather than margin. Specialty retailers were carving out categories that Sears had previously owned. Home Depot arrived in 1978 and began eroding Sears's hardware and home improvement business. Best Buy and Circuit City targeted electronics. Gap and others competed on apparel. Sears had been a generalist in an era when generalism was an advantage. As retail specialized, that generalism became a vulnerability. Management responses in the 1980s and 1990s varied. The company diversified into financial services, acquiring Dean Witter Reynolds and Coldwell Banker and launching the Discover Card. The logic was to capture consumer spending across multiple verticals. The execution was mixed, and the financial services businesses were eventually spun off. Raising cash, but removing assets that had provided a buffer. Sears also struggled with its physical footprint. Mall-based locations that had once been strategic advantages became expensive liabilities as mall traffic declined. Renovation capital was inconsistently deployed. The shopping experience in many stores deteriorated relative to competitors who were investing aggressively in store presentation and customer experience. By the early 2000s, Sears was under serious financial pressure. Comparable store sales were declining. The stock had underperformed. The company was searching for a structural answer to what was, at its core, a relevance problem. The answer it chose was a merger. In 2005, Kmart, which had emerged from its own bankruptcy in 2003, merged with Sears to form Sears Holdings Corporation. The deal was orchestrated by Eddie Lampert, a hedge fund manager who had acquired significant positions in both companies. Lampert became chairman of the combined entity and later its chief executive. The strategic logic offered at the time was scale. A combined entity would have greater purchasing power, shared infrastructure, and a portfolio of real estate that could be optimized. Critics questioned whether combining two struggling retailers created a stronger competitor or simply a larger version of the same problem. What followed over the next 13 years was a pattern that analysts, journalists, and eventually court documents would describe in considerable detail. Capital investment in stores was reduced substantially. The company did not significantly modernize its retail experience or compete effectively with the accelerating threat from e-commerce. Amazon's growth through this period was rapid and well documented. Sears's response was late and underpowered. Meanwhile, the company's real estate holdings were separated into a publicly traded REIT called Seritage Growth Properties in 2015. Sears sold properties to Seritage and then leased them back. The transaction raised approximately $2.5 billion. Critics argued it stripped the company of owned assets while creating ongoing lease obligations. Lampert and Sears disputed that characterization. The transaction itself was publicly documented and scrutinized in subsequent bankruptcy proceedings. The private label brands, which had been among the most durable assets in the portfolio, were managed under a separate structure. Craftsman was sold to Stanley Black and Decker in 2017 for approximately $900 million. Kenmore and Die Hard remained with the company as it entered bankruptcy. The financial deterioration across this period was significant. Sears Holdings reported net losses in multiple consecutive years, leading into the bankruptcy filing. The company's debt load was substantial. Store closures accelerated. By the time the Chapter 11 filing arrived in October 2018, the company had already closed hundreds of locations from its peak footprint. The bankruptcy process was contentious. A going concern bid was submitted by a group connected to Lampert. Creditors challenged aspects of the transaction and the prior asset transfers. The bankruptcy court ultimately approved a modified version of the going concern bid, allowing a smaller Sears to continue operating. Litigation related to prior transactions continued after the initial bankruptcy process concluded. What remained was a company operating a fraction of its former store count under significant constraints in a retail environment that had only become more competitive. The Sears and Kmart brands continued in a reduced form, but the institutional scale, the cultural presence, and the economic weight were gone. The Craftsman tools now sold under Stanley Black and Decker. The Sears Tower in Chicago had been renamed the Willis Tower years before the bankruptcy. The catalog, which had started everything had been discontinued in 1993. Each of those departures had arrived before the final collapse, quiet markers of a retreat that had been underway for decades. The mechanism here was not a single decision, and not simply the arrival of Amazon. It was a compounding sequence, a dominant model built for one retail era, facing competitors better suited to the next. A diversification strategy that did not protect the core. A merger that added scale without adding competitiveness. A capital allocation approach that reduced investment in the customer experience during years when competitors were accelerating theirs. And a balance sheet that left little margin for error when the environment turned. Every empire looks permanent at the top. Sears looked permanent for a very long time. The cracks, in retrospect, began earlier than most people noticed, and by the time they were visible to everyone, the distance back to stability was longer than the company could travel.